Hey everyone, and welcome back to my channel where we discuss everything related to investing. Silicon Valley Bank was officially closed Friday and was taken over by the government of California, causing investors to panic and causing the financial sector to fall. SVB Financial, the parent company of Silicon Valley Bank, announced on Thursday that it plans to raise more than $2 billion in funds to offset losses on bond sales. This move directly caused the stock price to plummet. It caused a huge panic. The FDIC announced on Friday that Silicon Valley Bank had been shut down by California regulators. In this video, we will talk about what's going on with Silicon Valley Bank and will it become another 2008 financial crisis. SVB Financial is the parent company of Silicon Valley Bank, which counts many startups and venture capital firms as clients. SVB Financial invested tens of billions of dollars in assets that appeared secure, mainly longer-term U.S. Treasury bonds and mortgage securities backed by the federal government. At the end of 2021, SVB's securities portfolio had increased from roughly $27 billion in the first quarter of 2020 to about $128 billion. These securities are at virtually no risk of defaulting. But they pay fixed interest rates for many years. That isn't necessarily a problem, unless the bank suddenly needs to sell the securities. Because market interest rates have moved so much higher, those securities are suddenly worth less on the open market than they are valued at on the bank's books. As a result, they could only be sold at a loss. By the end of 2022, SVB's unrealized losses on its securities portfolio, or the difference between the investment's cost and fair value, had increased to more than $17 billion. At the same time, SVB's deposit inflows turned to outflows as its clients burned cash and stopped getting new funds from public offerings or fundraisings. Attracting new deposits became significantly more expensive as savers' interest rates rose in tandem with the Fed's rises. At the end of March 2022, deposits had decreased from roughly $200 billion to $173 billion. And this year, it's speeding up. SVB predicted that its deposits would decrease by a mid-single-digit percentage in 2023 as of January 19. Yet, as of March 8, they anticipated a low double-digit percentage reduction. So, what led to this crisis? On Wednesday, Silicon Valley Bank said it had sold a large chunk of its securities, worth $21 billion at the time of sale, at a loss of about $1.8 billion after tax. The bank's aim was to help it reset its interest earnings at today's higher yields, and provide it with the balance sheet flexibility to meet potential outflows and still fund new lending. It also set out to raise about $2.25 billion in capital. Following that announcement on Wednesday evening, things seemed to get even worse for the bank. The share sale announcement led the stock to crater in price, making it harder to raise capital and leading the bank to scuttle its share sale plans. And venture capital firms reportedly began advising their portfolio companies to withdraw deposits from Silicon Valley Bank. On Thursday, customers attempted to withdraw $42 billion in deposits, or almost a quarter of the bank's total, but Silicon Valley Bank ran out of money, according to a California regulator filing. So, in short, Silicon Valley Bank encountered a classic run on the bank. And the main cause behind this might be the Fed's hike. However, some analysts think that the Silicon Valley Bank collapse is more company-specific for now. U.S. Treasury Secretary Janet Yellen said that she is keeping an eye on numerous other banks in light of the Silicon Valley incident. Fortunately, loans are not a much larger percentage of the assets of most other institutions. Overall, Silicon Valley Bank is dealing with a rather singular event that is unlikely to have larger systemic consequences. However, what the market fears the most is uncertainty. This type of concern is more significant than actual risk. We as retail investors, the best thing to proceed at this time may be to remain careful and wait and see. Don't make impulsive investment decisions. If you have other opinions, let's comment below. Please help to like and subscribe.